Taylor Riggs in for Emily Chang, and this is Bloomberg Technology. Coming up in the next hour, Google gets fit. The tech giant will buy Fitbit for $2.1 billion in the effort to boost hardware. We have details. Plus, a matter of national security, the world's fastest growing app, that's TikTok, is said to be under review in the U.S. At issue, its Chinese owners. And streaming wars intensify. Apple's TV Plus launches, marking a critical moment for the company to sell content and services to 900 million iPhone users. But first, our top story. Google agreeing to buy Fitbit in a deal worth $2.1 billion in cash. Shares in the fitness tracking device company jumped on the news. And with more on the deal, as well as what regulatory scrutiny it may encounter, I'm joined by Bloomberg's Garrett DeVink. Garrett, I wonder, what does Fitbit know about hardware and software and health that Google doesn't?
Yeah, I mean, it's a great question because Google has a big hardware business. They've got phones, they've got laptops. They've been rumored to be talking about building their own watch for a long time. They have an operating system for smartwatches, but that operating system has sort of been eclipsed by other competitors. It's not as popular as Android is in the smartphone world. And so what Google's kind of doing here is saying, let's go buy Fitbit. They have about 10% global market share and sort of build out our business from that.
Garrett, I'm taking a look at a company like Fitbit, which has seen its third annual year of sales decline. Why is Fitbit an attractive choice?
I think Fitbit is sort of, one of the few choices out there. I'm not sure in terms of attractiveness if that's really what's going on here. Fitbit, like you said, has been declining. They've really struggled to compete with Apple as Apple came out with the Apple Watch and sort of which can do things that a lot of the Fitbit devices just can't. And so I think, Fitbit was available. The price was quite a premium to where it's been trading earlier this year, but it's still a lot cheaper than it was when it went public several years ago. So in a way, this is a small amount of money for Google, and it can use this technology to sort of add to its business and just kind of throw more things against the wall.
And Garrett, talk to me more about that ecosystem. We know that they bought the intellectual property of Fossil, which is also a watchmaker. How does this combination now integrate further the hardware with the software?
Yeah, I mean, I think, what I'm curious about is, how much Google's actual wearable OS, which they call Wear OS, actually, comes out, or whether they just decide to scrap it completely and go with Fitbits, or maybe design something completely new. But, we don't know this for sure, but I do think it's likely that Google will eventually come out with its own watch, a Pixel watch, so to speak, named after its phones, and sort of just to complete that ecosystem. It's trying to kind of play into what Apple's doing. Apple's got phones, watches, laptops, and Google says we want to do the same thing.
And I also have to ask about this regulatory scrutiny. We're getting more House of Representative members coming out, in particular this case, David Cicciolini from Rhode Island coming out and saying that this really does raise some red flags. What's the antitrust scrutiny on this deal? Yeah,
I mean, so Google obviously already under a lot of scrutiny from state attorneys general, from the DOJ, from the House of Representatives, from individual senators who have an axe to grind against Google. And a lot of those sort of usual suspects kind of came out already and said today that, nothing in terms of particularly new investigations, but they said, really, Google, you're already under all this scrutiny and you're going to go buy another company? And so I think, another person I spoke to today sort of said that this was Google sort of thumbing its nose at regulators, or saying, well, we know you guys are looking at our business, but we're still going to go out and do this. Of course, from a traditional antitrust perspective, buying a watch company shouldn't necessarily raise flags because Google doesn't have a watch of its own, but it is buying a lot of data. Obviously, Google, one of the biggest data companies in the world, and that will probably be the tack that investigators take when they look at this deal.
Well, it is another day in big tech and another use of cash day. That is Bloomberg's Garrett DeVink. Thanks for joining. And now, with more on the kind of atmosphere that the Google Fitbit deal finds itself in terms of tech M&A, I want to bring in Greg Becker. He is the CEO of Silicon Valley Bank. Greg, I know you can't comment specifically on this deal, but generally, what is the tech M&A environment like right now?
Yeah, so I'd say think about exits overall, so M&A and the IPO market. I think it's still a healthy environment. There's a lot of great companies out there that are still doing well. Some that have intellectual property, which is the way I think Fitbit comes into play with the Google acquisition. So I look at it overall. There's a lot of money, a lot of good companies, and exits are actually relatively healthy right now.
So when you say there's a lot of money, are these deals? Are you seeing more cash, credit, equity?
Yeah. So the main two, I guess, sources of capital going into companies, right? So equity is one and debt is the other one. By far, the dominant portion, at least for the innovation economy, is equity. And equity is coming from venture capital, who are raising larger and larger funds. It's from sovereign wealth funds. It's from family offices. And if you think about it, I mean, where interest rates are right now, there aren't that many places in the world for growth. And innovation is a place for growth. So obviously money goes where growth is. And so you see a lot of equity going into this space. And I think it's going to stay that way for quite a while. I don't see that slowing down. It may be a little bumpy, but I think it's going to be fine. On the debt side, obviously, that's another place where companies can raise cash to support their business. That's what we do. So it's important to us. It's a very competitive market, and there's lots of money out there in that space as well. Obviously, we've grown dramatically, and part of it is to put money into the innovation economy. So it's really debt and equity, and they're both pretty healthy.
And I'm taking a tally, and I've heard the term "a lot of cash" being used a lot, and
Yeah.
we hear that there is a lot of cash chasing too few investments. What is that doing to valuations?
So let's take a step back on that. Because when you look at how much venture capital is flowing into the system this year, so far through three quarters, it's about $97, $98 billion, right? It'll be the second year in a row that the dollars are more than $100 billion invested, which is, by comparison to history, if you go back 5 years ago, 6 years ago, that's a pretty big jump. But it was back in 2000 where it was only $100 billion. So from the standpoint of almost 20 years ago, it's just about the same amount of cash. And when you think about it, the market is so much bigger than it was back then for all the obvious reasons. So companies are staying private longer. And so from my standpoint, it's a lot of money, but when you put in context of historical, right, number one, and you look at the $100 billion relative to the global capital markets, it's not that much money. So my view is that in some ways valuations are heating up, but it depends upon what sector you're in and what stage.
Has SoftBank structurally changed your world?
It hasn't had a big impact on our world. If you think about the innovation space, what SoftBank has done is the following. They're putting large slugs of money into these companies that are allowing two things to happen. One is they can stay private longer, number one, and number two, it actually allows them to go after really, really big ideas. And so those two things, I would say, help the innovation space. Now, when you're making big bets like that, they don't always work out. And sometimes when they don't work out, they get a lot of headlines. And a lot of us are talking about WeWork, which is kind of on the front of everyone's mind. But I do believe it helps put more money in the economy, more money in the innovation space, and I think from that standpoint, it's actually okay.
You have a lot of clients. I'll bring up some of the specifics. Datadog, which has done very well since its IPO.
Absolutely.
Peloton, which is trading right now below its IPO price. How is the market deciding and differentiating between what IPOs are successful and what aren't?
Yeah, I think that's changed, obviously, which is why we're talking about it a lot. I think over the last early part of the year, and even into the prior year, companies it was all about growth. It was, don't worry about profitability, focus on growth. And in fact, in a lot of prospectus S1s, they didn't really have a good time frame when they were talking about becoming profitable, or it was so far out that it was just hard to kind of comprehend. That's different than it was historical. Usually you'd be either profitable or you'd see profitability within a short period of time. So from my standpoint, I actually think it's changed. People are more focused on profitability now. And I think that's actually overall healthy for the environment. So I feel good about where we are.
More focused on profitability and more healthy from the environment. That's going to be my takeaway. Thank you to Greg Becker, Silicon Valley Bank CEO. And coming up, the unstoppable hack that appears to be one Chinese hacking group has been unleashing on some high-value targets. That's next. This is Bloomberg. TikTok is one of the most popular music video apps in the world, and now it is being investigated as a national security threat in the U.S. TikTok, which was formerly known as Musical.ly, was bought by China's ByteDance 2 years ago for almost $1 billion. And now the Committee on Foreign Investment in the United States is reviewing the app's growing popularity amidst increasing concern about TikTok's growing influence in the U.S. To tell us more, it is Bloomberg's global executive editor for technology, Tom Giles. I have to ask, why now?
Yeah, so right now, CFIUS is taking a close look at a lot of things, even things that have happened in the past. You'll remember that there was the acquisition of Grindr, the dating app. And now what CFIUS is saying is that that needs to be divested. And so the concern is, foreign ownership, Chinese ownership of something like that could represent some kind of a national security threat. What's happening with TikTok, which, as you said, has become very, very popular with a lot of young people, a lot of young women, a lot of young men. And the concern is twofold. One, is it engaged in censorship that goes against American values? Two, what's it doing in terms of gathering data, the data that it's amassing and that could be accessible to the Chinese as a result of, this ownership?
Well, and like you said, a bipartisan issue. You had a Republican, Tom Cotton, Democrat, Chuck Schumer, all coming out and saying that this should be reviewed by CFIUS. Does that help or hurt the case that this is now a bipartisan issue? And
Marco Rubio as well. Look, that probably has helped raise the level of urgency around it. It does show that this isn't just one party or the other party in our political sphere where things have become so partisan. It is, I think it's interesting that there are some things that everybody can rally around, and one of them is fear of China. And does this confirm from your bird's eye view, let's call it, that CFIUS is now more involved in all of these technology deals, frankly, that are happening cross-border? It's taking a look at it's taking a much deeper look at a lot of deals, even deals that have already passed, that have happened years ago, smaller size deals. Scrutiny of anything that has to do with China, China's investment in the U.S. China wants to buy a U.S. company, wants to take an ownership stake or even a minority stake in a U.S. company. It's all getting reviewed much more intensely in large measure in light of the trade war. Yeah, Bloomberg Technology's Tom Giles, thank you for joining. And sticking with China and national security, Chinese hackers are said to be targeting high-ranking military and government officials. APT41, it's a Chinese state-linked hacking group, is using malware to steal SMS text messages from their targets. That's according to cybersecurity firm FireEye. So to discuss in Washington, it is John Holtquist. He's the director of intelligence analysis at FireEye. John, what did we learn today about targeting specifically SMS text messages?
So during an incident response, FireEye discovered a piece of malware that was designed to essentially look at SMS traffic on a telecommunications provider. It allowed the Chinese hackers to search by phone numbers and other distinguishing characteristics belonging to the users, but it also allowed them to troll for specific terms or keywords. That included intelligence and military terms, as well as terms related to groups that are politically at odds with the regime. John, is text messaging the new threat? So often we talk about email, for example. Why text messaging? Well, text messaging is used in a variety of applications. Some groups, some people are certainly making a move to more secure encrypted applications, but it's important to remember that these adversaries are going after them as well. So almost all messaging is really under threat right now. Underscoring all of this is the concerns about Huawei as well. So considering that Huawei has been, on the sanctions list, but trying to gain some ground in the U.S., does this underscore that fears were correct about Huawei? Well, I can't speak to any specific company, but I can say that China is acting on a global scale to subvert telecommunications. John, what have you learned about increasing hacking in 2019? How has it changed, specifically from China? Well, China has strayed away from a lot of the intellectual property theft that we saw so much of before. They are refocusing on the traditional classic espionage targets. That includes dissident groups for them, as well as military and intelligence targets. One of the important things to know, though, is they are maturing and moving towards things like places like telecommunications providers. They're moving upstream where they can gain access to a lot of people simultaneously.
And some of the concerns about this SMS texting or messaging is there's nothing that me as the user can do to protect myself, right?
That's right. This actually takes place on the telecommunications provider's network and not on your phone. So it's very hard for you to actually take some action to protect yourself here. You might look into an encrypted service, or in the worst case scenario, you have to really watch what you communicate.
Do you have any sense of how effective it is? I mean, I hear that these communication providers, it's the most secure method, right? Obviously, you get off of Wi-Fi and you just rely on your provider. Is there any evidence that those aren't as secure as we thought?
There has been some very recent incidents where we know that nation-state actors are looking to gain access to those providers. You know, as more and more people use single providers or a handful of providers, nation-states will be interested in targeting them specifically, and they'll put a lot of resources there. So they may take great effort to keep your communications secure, and they may be more secure than usual, but there should be no mistake that these adversaries are looking to break in there.
And John, quickly, finally here, any sense that as we head towards the election, is it China? Is it Russia? Who are you most worried about?
I'm still most concerned about Russian actors. They are still very aggressive. News came out very recently that they are again targeting the Olympics in response to some of their troubles as far as being accepted into the games. I think that's a sign that they have not given up their aggressive ways, and that they'll be equally willing to interfere in 2020.
John Holtquist of FireEye, thank you for joining. And coming up, the wait is over. Apple's debut into original content, it is here. We talk about Apple TV Plus and the continued streaming wars next. This is Bloomberg. Apple ended years of anticipation about its next act in television on Friday. The company launched the Apple TV Plus original video streaming service. It will offer new shows to match rivals, but the service is lacking what many consumers want, and that is a big library of their favorite movies and TV shows. To discuss, we are joined by Dallas Lawrence of OpenX, and also with us, Wedbush Managing Director Dan Ives. Dan, how far behind is Apple?
And they're far behind from a content perspective, just spending about $1 billion a year. Look at Netflix, $15 billion. Combined, you have others spending $10 to $12 billion. So they're behind. But if you look at the Apple brand, you have 900 million iPhones worldwide. It's an iconic brand and an unparalleled install base. So they're behind, but ultimately right now they're diving into the deep end of the pool. We think 20 million subs the first year, 100 million 3 to 4 years out. This is a company that, just given that golden install base, you can never count out.
Dallas, your take on Apple's position here, the strengths and the weakness relative to its big competitors.
Yeah, I think Apple has really 3 advantages and 2 key challenges. On the advantage side, I agree with Dan. I think the biggest advantage is distribution. Apple's going to be positioned to be the #1, I think, mobile streaming platform in the not too distant future, which is huge because mobile is the accelerant driving the growth of streaming. I think the second key strength they have is pricing. Apple has been very aggressive on the pricing here, coming in at $4.99 a month, far below everybody else. But most importantly, Apple TV is going to be free for any new subscriber in the next 12 months. And why that is so critical is 45% of U.S. adults don't stream today. They've not joined a streaming service, and Apple is now giving them the chance to dip their toes in for free to try some of their content over the next 12 months and really hope they love it and join it. The third, I think, clear advantage is just Apple's resources, $250 billion. No studio in the world has that to match. On the other side of the ledger, the challenges, two huge challenges. The content challenge is enormous. This is the weakest by far content offering of any streaming channel out there. They're going to have 9 shows in the first year, maybe 12. None of those are going to be bingeable. That's compared to 5,000 shows on Netflix, 2,000 shows on Amazon. So a real content challenge. I think hopefully that huge resource pile they have, they can correct quickly. And I think the second challenge is just one of competition. We're going to see a number of new streaming entrants enter the market in the next couple months, the most anticipated of which is Disney in the next 2 weeks. By far, consumer polling came out last week. Twice as many consumers are excited and interested in joining Disney as they are Apple. So clearly some competitive headwinds, but also I think some real tailwinds that will propel Apple as well.
Dan, I want to talk about content before pricing. With content and $100 billion of cash on the balance sheet, do they go out and bid for old content of all of our old favorite shows, or do they use that cash on developing original content?
Yeah, I think it's going to be a multi-pronged strategy. I think for the first thing is they're stepping up what we believe is $1 billion a year to about $6 billion a year. So organically really build out that content. And that's going to be more of a sort of long-term initiative here. I do think they're going to start bidding on some of that content that's out there. But as you've seen with Friends and Seinfeld and others, that continues to be an expensive proposition. But we believe it's all the drum roll to them making a large acquisition of a studio in 2020. You know, we've talked about MGM, Sony, Lionsgate, A24 as ones that fit. I think that's sort of the 1-2 punch, how they get there in terms of they built the fortress, now it's about building the content.
Mm-hmm. You know, Dallas, I want your thoughts next on pricing. $4.99, is that appropriate? It is cheaper to some of the competitors. And then your thoughts on integrating that free service if you buy a new device to further draw people into that business.
Yeah, look, I think the important thing to remember about Apple is they don't actually have to win the streaming war. It is do or die for Netflix. For Apple, it's about strengthening the services side of their business that they're growing and evolving. We just saw yesterday services are growing very strongly for Apple, about a $12 billion business today. I wouldn't be surprised in the near future we don't see Apple News, Apple Arcade, their gaming service, Apple Music, and Apple TV bundled together in a content platform that really becomes the de facto way in which we enter the streaming universe. The other thing to remember about the Apple TV is it really is a platform with which you can build your own mini streaming bundles within. So you can subscribe to HBO and Showtime and those other channels within your Apple streaming platform. So I think the longer game to be looking at here is the overall services play they're making. Now, I think the $4.99 fee is very aggressive. As I said, it's the cheapest in the market by far. But they kind of need to be in that space, just given the lack of content I think they have in the first 12 months pipeline.
Our thank you to Dallas Lawrence of OpenX and also Dan Ives of Wedbush. You are going to be sticking with us. And coming up, it has been a week full of earnings, acquisition, policy changes for political ads on social media. The list goes on. We go over the biggest tech stories in this week's Tech in Review. That's next. This is Bloomberg. This is Bloomberg Technology. I'm Taylor Riggs in for Emily Chang. Now to our weekly roundup of the top stories in tech. Now the biggest story of the day, it has to be Google agreeing to buy fitness smartwatch maker Fitbit. The price, a cool $2.1 billion in cash. The deal could shore up Google's hardware business, but it could also increase scrutiny by antitrust regulators. To discuss, we're joined by Matt Maley of Miller Tabak, and still with us is Dan Ives of Wedbush. Dan, let me pull you in here as an analyst here. What are the antitrust scrutiny issues like for you?
Look, right now, this Beltway versus big tech battle, I mean, this is going to get a very close microscope in terms of deal from an antitrust perspective, in terms of Google buying Fitbit, what that speaks to from a consumer perspective, that data, are there any antitrust worries? And I think this is something that I think investors are going to focus on to see, how long this deal takes to get done. But I think it just speaks to the broader swirls going on right now for Google, Facebook, and others, especially in the Beltway.
And Matt, as you've been following both the fundamentals and then the technical portion of this, what do the technicals show us about how Google is positioned when they were looking at Fitbit?
Well, obviously the stock has had this, finally had this great move. It had been underperforming a lot of the stocks this year until its most recent bounce. But that's taken up to its double top high from each of the last 2 years, the second time being the first half of this year. And so if it can break out of that kind of double top high, it's going to be very, very bullish for the stock. But I agree with Dan. Some of the regulatory and political headwinds that it faces, it's still going to be tough for this name. And it's going to have some very interesting implications for the M&A business or M&A situation in the technology sector going forward.
And Dan, does this even give them now a fighting chance against the Apple Watch?
I think that's going to be a massive uphill battle. I mean, if you look at what Apple's done, they've really cornered the market, and I think they've done a phenomenal job in Apple Watch, even though it was a little bumpy out of the gates. And I think right now for Google, this was the opportunity. They needed to, especially on wearables, they saw where Apple's going, they see where other tech players are going, they saw the Fitbit asset. This was an opportunity, but I think it's an offensive move, but also a defensive move at the same time. But right now, Apple, they continue to be at the top of the mountain. I think Google's looking up at them.
And Matt, your thoughts on the general M&A climate as well? Does this just continue to mean that we're buying instead of innovating?
Well, it seems to be that way. I mean, the problem is that the big players have so much money that they can force people out of certain businesses, some of the small players. And it's very interesting, after this whole IPO blow up of the past year, not just in technology, but in other areas, people, we're starting to hear from some of the venture capitalists and private equity guys that the people they're talking to, instead of saying, oh gosh, we can build this great product, we'll take the company public someday and we'll make $1 gazillion. Now they're almost saying, geez, I'm worried about the IPO market. Let's try to make our products so somebody else can take us out and buy the company rather than try to take it public. So they have all sorts of implications. But as Dan says, big is not so good right now in the political atmosphere. So investors are going to have to be very, very nimble as we move forward between now and the election, which is almost exactly 1 year away.
Well, and Matt, as we talk about M&A and the regulatory environment, I switched to the second big topic of the week, and that was arguably Facebook. And then we learned on their earnings call that regulators are really zoning in on their purchase of Instagram, and that is going to be a key area of focus from the antitrust perspective. The odds, how is the stock pricing in a potential that Facebook and Instagram are broken up?
Well, it's funny because when you get to these situations where the political aspects fall into play, it's usually not that big a deal, except when it comes to an election year. And this, I think, is only going to grow. I mean, you've got a lot of people, especially the GOP. People talk about the impeachment situation. If that starts to grow, a lot of GOP people are going to start saying, okay, what can I do to differentiate myself? So I'm going to go even harder on the Facebooks of the world. The one thing is, though, as we saw in the last election cycle with the healthcare stocks, that the things kind of petered out before the election, by the summer of the election year. But that's still, 6-9 months away. So to me, I think that you're going to see ever-increasing pressure, not just on the presidential campaigns, but in the Senate and House campaigns, and that will push them to go after these companies even harder. So whether they actually break them up or not, I don't know, but the headwinds and uncertainties surrounding them will keep a lot of these, especially a Facebook and a Google, keep these stocks tampered versus some of the other names that have been breaking out.
Dan, I have yet to hear your thoughts on Facebook's stance on political ads versus Twitter's opposite stance. Who's right?
I think it's a smart move for Facebook. And I think you've seen Sheryl as well as Zuckerberg, the way that they're approaching this. They're going on the offensive. And I think they're going into this election from a security perspective, and they built out that platform. And they're not shying away. And I think that's sort of the right strategy here. Because you look at Twitter and Facebook, Twitter continues to still be licking their wounds from a train wreck quarter. They make this sort of announcement, which is a bit of a head scratcher. Makes them seem like, maybe they're playing nice in the sandbox. But for Facebook, I think they're confident in terms of where they are moving forward. And they're not shying away. And I think that's something that they're trying to really, from a messaging perspective, show. And I think ultimately from a street perspective, look at the numbers. Engagement, advertising continues to be robust despite the noise from the Beltway.
The third big story of the week has got to be about Apple. And Dan, I want to start with you here because when we got phase one of the trade deal, we called you. You phoned in on your cell phone from your car on the way to the airport. And you said if there was a phase one trade deal, this could be a significant re-rating for Apple stock. Today, we learned that they've asked for a reprieve of those September 1 tariffs that are hitting the AirPods, the watch, some of the Apple components. How much more about trade is really impacting Apple's fundamentals?
Look, I mean, you take a step back, they're still the poster child for the U.S.-China UFC trade battle. But part of what you're seeing with the stock getting re-rated here, and we believe on its way to $300, is that continues to be the sort of the China story. I think you look at tariffs right now, it's a contained situation. I think December 15th continues to be sort of a key date everyone's focused on. But right now, instead of burning iPhones in the street, pro-nationalism, pro-Huawei, instead what Chinese consumers are doing is buying the phones. And I think you saw that in numbers. And I think this was a seminal moment for Apple in terms of where they are today.
And Matt, you get the final word here on Apple overbought or oversold at this point.
Well, it's definitely getting a little overbought. I mean, there's no question it's a great company, a great stock. But if you look at its RSI, its weekly RSI chart, it's the most overbought it's been in over 2 years. In fact, it's more overbought than it was last September, just before we saw the big correction. But that was, of course, that correction was more to do with the broad stock market than anything else. So what I'm not saying, geez, you should short the stock, or I'm not saying you should take major profits. I'm just saying you probably shouldn't chase the stock. You will get I think, an opportunity to buy it a little bit cheaper, purely on a technical basis. And I do think, I'm not just talking about 1 or 2%. I think it could pull back 5 to 7% or even a little bit more. That would be healthy. It would be fine. I know that goes in the face of the really strong fundamentals it sees right now. But as we all know, the stock market acts in funny ways sometimes. And so I wouldn't want to chase it here, at least not in an aggressive way. Look for lower prices.
A lively week in review that was. Thank you both to Matt Maley of Miller Tabak and Wedbush analyst Dan Ives. And now we're also getting some political news on Friday. Democratic presidential candidate Beto O'Rourke has confirmed he is dropping out of the presidential race. The former Texas congressman has struggled for months to recapture the energy from his 2016 Senate run. His campaign was said to be under extreme financial strain, and as a result, he may have had to make some deep cuts to his staff in order to pay for ads. And coming up, a Canadian e-commerce company says it is not competing with Amazon, but helping other people to do so. We hear from Shopify. The CEO is next. This is Bloomberg. Shopify is spending $1 billion to set up a network of fulfillment centers in the U.S. to help its merchants deliver products. The Ottawa-based e-commerce company is one of Canada's best-performing stocks. Shopify CEO, it's Toby Lutka, sat down with my colleague Caroline Hyde to discuss the company's growth plans at the Sooner Than You Think conference in New York. Take a listen.
The investors want what investors want. It's perfectly good. We said we would invest a lot of money into, like $1 billion into fulfillment, because we need to help our customers grow their businesses, and therefore we go in logistics where consumer expectation is going towards at least 2-day delivery, and this is something we want to help everyone with. And so we'll have to spend some money. We said that when we announced the it on stage and the acquisition of 6 River Systems recently, and that's what people are reacting to, and that's okay.
Are you surprised by the negative reaction to continued growth and investment?
Well, I work every day, and my team, the way we're thinking about it is we are working on the fair market value of a business, and the stock price eventually converges on this, and we're not getting too concerned with the day-to-day movements of it.
Okay, interesting. You were talking there about 6 River Systems, a purchase you recently made, robotics within warehouses, making delivery and that much more efficient. Any more M&A on your horizon to ensure that you scale at the pace you want to?
Yeah, Probably, but no plans right now. I think this is a really good acquisition because it fits perfectly into the narrative and what the company wants to do. We're trying to make it much easier to be entrepreneurs on the internet. We've done this. We have 1 million merchants on the platform, and it's helping them scale their businesses, just what we want to spend most of our time on, and extending this into logistics, warehouses, making sure that warehouses run with good robotics. Those are the kind of things that Shopify is best at.
You focus on, of course, the need for 2-day delivery. Amazon's raised the bar with 1-day delivery. How do you find the constant competition coming from Amazon and the need of your clients being somewhat different?
Yeah. One of the most wonderful things is this inspired discontent of all the shoppers and all the merchants, always holding us to the highest standards, and we will strive to, like, if teleportation is invented tomorrow, we'll use that to deliver all packages, but failing that, we'll try to get things to everyone in 2 days. Hopefully one day, at some point in the future, we figure out how to do it in 1 day, but right now there's no plans.
What sort of technological innovation and focus do you think there will be are you seeing drones on your horizon anytime soon, or how do you think it will become that much more efficient as time progresses?
I think the most important thing is that packages and all these kind of things have to travel by any means possible, right? Like, we can go futuristic to drones, we can go really old school to bicycle couriers, and I think it's important that in different situations with different orders that have to travel different distances, we have to learn as an industry how to utilize all those opportunities, rather than have a very rigid idea about sorting centers at a certain place outside of a city and then a truck, and which hopefully only does right turns. And I think we can move on a little bit through technology.
You mentioned that you have more than 1 million merchants that you work with, globally distributed. What are some of the cultural nuances that you find in the customers that you serve from country to country?
It's super interesting. Like, commerce and retail is actually deeply woven into the cultural narrative of every country. It involves laws in many places. Like, for instance, I'm from Germany. In Germany, the politicians decided what exactly the add to cart and the checkout buttons need to say and how big they have to be. And its payments are very, very different. We see mobile payments take off in some parts of Africa and, of course, in Asia, where credit cards prevalent. So it is one of the most interesting things in the company for everyone to, like, really figure out, how do we take something that kind of works, like people are using Shopify everywhere, but how do we get it to be as good a product market fit for the entrepreneurs of every country as it might be in the United States? And there's no end to the surprises there, and it's really fascinating.
That was Shopify CEO Toby Lutka. And now, sticking with e-commerce, Fair. It's a wholesale marketplace with a focus on partnerships with local retailers. The platform launched in 2017 and believes the future of retail is local. Joining us to discuss, it's Fair CFO Lauren Cooks-Leviton. She's a 25-year industry veteran and most recently served as the CFO at Fanatics, a leader in licensed sport merchandising. Lauren, great to have you. And I want to just kick it off with news of the week, which is $150 million in funding, putting you at a $1 billion valuation. What are you using the money for?
Well, we have a lot of growth opportunities. This is a business that's grown very rapidly since its founding just a couple of years ago. And so the big priorities are continuing to add tools to service both sides of our marketplace, which, like you said, are local retailers and independent brands. And we'll continue expanding categories and continue expanding geographies. We most recently added apparel, and we most recently entered the Canadian market, and both of those businesses are doing well, and we'll continue to use those funds to pursue those growth opportunities.
Your tagline, betting sort of on the local consumer, goes against a lot of what we hear. Why are you betting on the local consumer?
Well, it's so interesting. I mean, that I shared this same perception that, you know, everyone hears about this retail apocalypse, and the apocalypse has missed local retail. We we have found that those local retailers have really learned how to compete, and the fair marketplace is allowing them to have more tools at their disposal to be competitive. So we give them, we give the makers the opportunity to find new retailers that want to buy their goods on a wholesale basis, and we give the retailers the opportunity to get 60-day terms and to try before they buy. They can return products from new makers that don't sell for them. So we're making them more competitive, and frankly, consumers are interested in that. They're interested in having distinctive, unique collections. They're interested in being able to shop in their own communities and not have their main streets be either dull or vacant. And Fair is really allowing both sides of the marketplace to succeed.
You also say on your website one of the most searched at filters is a filter that says not sold on Amazon. How are consumers differentiating between what they want on Amazon and what they want local?
Well, we think Amazon is really providing people with convenience and breadth of assortment. What local retailers are able to do is provide people with something really unique and distinctive. And those retailers want to make sure if they make a relationship with a consumer around some unique product that they have curated and provided in their store, they want to make sure they'll continue to have the opportunity to sell that. And that's why we think that is the #1 filter.
You have a very good read on the consumer. Is the consumer as healthy as the data show?
Well, our growth would certainly suggest that that is the case. As recently as early 2018, we were doing about $1 million of volume on the platform a month. We're now in the peak season for holiday leading up to 2019 doing over $1 million a day. So we're certainly seeing tremendous indications that the consumer is strong, and we hope that that will continue to be the case.
What is the biggest question investors have asked you?
I think the biggest question really is around that notion of the death of retail, and is the local economy really as vibrant as we believe it is? That's something that we think the success to date of Fair has demonstrated that, in fact, there is a local economy that's thriving.
Lauren Cooks-Leviton of Fair, thank you so much for joining us. And still ahead, it is Blockchain Week in San Francisco. It's wrapping up. Blockchain firm Cadena believes that the technology is not a hype, but already changing lives. We hear from the firm next. This is Bloomberg. San Francisco Blockchain Week is wrapping up, and Cadena is the first blockchain technology to come out of JP Morgan's Blockchain for Excellence program. But there is still a lot of skepticism around the world about blockchain and cryptocurrency. Here to break it all down and tout, of course, all about it is Cadena and the firm's head of research and networks, Monica Quainton. So first, Monica, I want to talk about what Cadena is. On your website, you have a very clear picture solving the scaling issues of Bitcoin and the security issues of Ethereum. Is that how you're standing out?
Right. So we like to position ourselves as the next generation of smart contract platforms. And for that, what that means for everybody who's not constantly immersed in blockchain things is that a smart contract platform is essentially a way to create an application on top of a blockchain and have it run in a decentralized way, so that even if your central server somewhere is taken down, your application won't be taken down. It's this whole idea of resiliency around blockchain that we believe that a network should be decentralized and owned by its users and run by its users. And this idea of having a decentralized blockchain applications originally came from Ethereum and their idea of building applications in smart contracts. But Ethereum has some significant security holes, and when our team was originally at JP Morgan, we did a bunch of research on all the different blockchains that were out there and decided that we could do a good job making our own that was built on the technology of Bitcoin, that had its security profile, but had the innovation that was originally brought through Ethereum.
And I want to get to the news of the day, and we had CoinList on yesterday, and now we have you today, and you have a partnership with them launching on Tuesday. What can we expect?
Yeah, so we are doing a token sale on the CoinList platform, and it goes live Tuesday, November 5th at noon Pacific time, so 3 a.m. in New York, which is where our team is based. It's very exciting. We are still in that phase right now where nobody's really sure what the correct way is to go from a blockchain starting at zero to becoming a true decentralized network. But one of the ways is to get tokens into the hands of many people around the world so that they can then interact with and experience the network. And CoinList is really helping us with that. We're doing a sale through CoinList so that people all over the world can get access to the Cadena network tokens.
How has Libra changed the regulatory scrutiny around all of this?
It's really brought more energy and more people that before just thought cryptocurrencies and blockchain in general was so fringe, really into the limelight in a way that has actually been great for us, because people have started thinking critically about, well, if Facebook thinks this could be real, maybe it's not just some made up fringe technology, maybe this actually has potential. And all along, Cadena has been in the corner of, we think that blockchain is usable for business. It's usable for people to actually create resilient applications and transmit data in a secure way. You can track supply chains. You can track interactions between companies. We're right now working on a partnership with a company doing medical device tracking. And Facebook entering the arena has really, yes, it's brought more regulatory scrutiny, but honestly, more coverage from regulators that are forced to take this seriously maybe means that we might actually get some clarity.
We only have 20 seconds or so. So who is on our heels? Is it China?
Well, I would have said before last week that China was not a big player because they're so anti-cryptocurrency. But the president of China came out last week and actually said that he thinks that blockchain innovation is really important. So maybe we might actually see China being more open to cryptocurrency in a way that they weren't before, which means that the United States really needs to get their ducks in a row in terms of how they're going to treat cryptocurrencies going forward.
Monica Quaintance of Cadena, thank you so much for joining us.
Thanks, Taylor.
And that does it for this edition of Bloomberg Technology. Bloomberg Technology is live streaming on Twitter. Check us out at Technology, and be sure to follow our global breaking news network at TikTok on Twitter. This is Bloomberg.